only money.
Place your bets, ladies and gentlemen.
All this money talk, let's talk about what's the difference between stocks and bonds. We hear all the time that these are the investments that people make when saving into their retirement, but it could be time for a little brush up. So let's dive in tonight's all-new Money Talks. The main difference between stocks and bonds is that stocks give you partial ownership in a corporation, while bonds are actually a loan from you to a company or government.
Investors can balance their risk and reward in their portfolio through asset allocation. Asset allocation is the mix of cash, bonds, and stocks that you hold. Those are the three main asset classes. There are many different subcategories of bonds and stocks. For example, with bonds, you have corporate bonds, government bonds, municipal bonds. And on the stock side, you can choose between large, mid, small companies, international versus domestic companies, growth stocks, value stocks, and so on and so forth.
It's always nice to have cash on hand, but remember, cash doesn't make you money. Bonds do, but it will tie up a percentage of your cash.
Bonds offer a little bit more return than cash in exchange for some volatility. As we saw last year, bonds can be very volatile in response to interest rate changes and other factors, although they're going to be less volatile over the long run typically than stocks. Stocks tend to be more volatile than bonds, and especially cash, but stocks do offer higher long-term return potential.
As you get closer to retirement, more and more of your investments should be moving into bonds. But remember, the return isn't great.
The percentage of your portfolio that you hold in bonds versus stocks will affect your future volatility and your future return potential. So be sure you do your homework. Make sure that your mix is appropriate for your risk tolerance, time horizon, and your age and your financial goals.
Investors, you have to be smart and wary of down years for the market. So one has to consider inflation and how to stay in front of it.
Younger investors tend to hold more of their money in stocks because they have a longer time horizon to ride out the volatility. As you age, it can be a good idea to move more money into bonds and cash as you get ready to spend your dollars. Even retired investors will need money in stocks to outpace inflation over the long run. So don't move too much into bonds and cash, or inflation will eat away your purchasing power over time. I prefer to hold asset classes separately, so a stock fund and a bond fund, so that way I can customize my asset mix exactly the way I want.
Good advice there from Neil. A reminder that stocks typically trade on various exchanges, while bonds are mainly sold over the counter rather than in a centralized location, or maybe even through your work 401k. In the United States, the prominent stock exchanges include the NASDAQ and the New York Stock Exchange.